Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and also known by many of you as Mr. Valuation. I am a big believer that investors really need to have good information in order to be able to make sound and reasonable investment decisions, whether it's buy, sell, or hold on their common stock portfolios. And the problem is, the old saw that says statistics don't lie, but statisticians are darn liars is also very appropriate here or relevant here, because when you're dealing with statistics, even when they're correct, they can still be misleading and they can be used to mislead. And so I think one of the important things to do as a investor, something that's not really talked about very much, is to make sure that you understand clearly what the numbers are that you are looking at, what they represent, and how they're represented. And in that regard, I developed the FastGraphs Fundamentals Analyzer software tool, and we're constantly adding to the development of the tool to try to be as transparent as possible so that investors can make informed, sound, and rational investment decisions. Now, recently, I did have a subscriber to both FastGraphs and this YouTube channel, Barry Whitney, or Whitine. I'm not really sure how to pronounce your name, Barry, so I apologize. But here's what Barry's question was. And he asked this question on the Amgen video that I recently posted. He said, "Hey, Chuck, I have an off-topic question for you. I was showing FastGraphs to a friend. We were looking at a 20-year historical graph of MO Altria showing price correlated with fundamentals. We noticed that FastGraphs shows different prices than the actual prices paid for the stock. For example, in March of 2007, MO was trading in the 80s, and yet the FastGraph shows it in the 20s. What's the explanation?" Well, the explanation is that when a company engages in spinoffs like Altria did, and I'm going to go through some of those spinoffs for you, the original prices that Barry's talking about here, the $80 price, was correct if you were looking at the data correctly. But if you adjusted the data for the spinoff so that you could evaluate the company, as it currently exists, and go ahead and pro rata adjust the amount that the spinoffs took away from the company, you get an entirely different picture. So here's what Gary was referring to. This is our current chart. And I'm also introducing some new features on FastGraphs for those of you who are subscribers. And I hope Barry is watching this video because I wanted especially he and his friend to see how this works. Okay. I marked the stock here. This is March 9th of 2007. There's the $20 price, if you will, that quote unquote Altria, back then known as MO or Philip Morris, was actually trading at in the 80s, but our FastGraph shows it trading in the 20s. Okay, well, how is that possible? Well, it's possible because some websites and some data providers like ours, FactSet, it actually provides us the opportunity to look at the data both ways. A lot of pages will produce it in one way only. For example, let's go to Yahoo here. And this is Altria Group, or MO, the old Philip Morris. And here's the prices that Barry was talking about. I'll get about as close to it as I can. Here's April of 07. There's a $70 price. And, up here at January of 07, it was $87.81. And that's what the Altria stock price would look like if you don't adjust the data for the stock splits. Okay, this is what the original Altria, then we had the spinoffs, which I'll get into here in a moment. So on FastGraphs, what we've added to the tool that's not available currently, but is available on the new version, if you go up here to the settings gear here and click on it, you'll see split and spinoff adjusted. There's a little drop down. You can unadjust the numbers and simply save the changes. And this is what Philip Morris looked like prior to the spinoffs. Now, we used to draw the Altria. It was actually Philip Morris when Barry was talking about it. This is how we used to draw the graph. Okay, and right here was the spinoff of Kraft. Then we had the spinoff of Philip Morris International. So you had these two spinoffs. So if you looked back here and looked at the data on FastGraphs, for that around March of 87, if you will, then you do get that $85, $80 stock price that Barry and his friend were looking at and talking about. Okay, that's with the splits and the spinoffs. All right. Now, what spun off here, Philip Morris spun off Mondelez initially. Okay, and Mondelez ended up spinning off its stuff. So, there was the spinoff here of Mondelez, and then, or at least it merged with them. And then you had Philip Morris International, which was a big one. This is where, they spun off in 2008. And again, if I go back to Philip Morris, and this was, right in the throes of the recession, or Altria, I keep calling it Philip Morris because I followed the stock for 50 years, and I always referred to MO, which stands for Morris, as Philip Morris. But anyway, there's the spinoff of Philip Morris International. But then you also had additional spinoffs involved here. You had Kraft spinoff, which eventually became the Kraft that's merged with Heinz. Now you have the Kraft Heinz. So if you were going to be analyzing, the company, you would have to go looking at all these different spinoffs. Okay. Now, if you go to Google Finance, you'll notice that Google Finance uses the same adjusted data that we use on FastGraphs, where you got that $19, $20 price back in March and April of 2007. If you go to Yahoo, they don't split adjust the prices. Okay, in FastGraphs, we give it to you both ways. We give it to you where you can look at any of these companies prior to the spinoff and then what happened after the spinoff. Okay, and we can do the same thing with other names that are very popular. For example, another one that's been quite known is Abbott Labs spinning off of AbbVie. So here's when the spinoff occurred, as you can see it, and then the stock price adjusted. But if I, go back into the little gear here, and I go back into the split and spinoff adjusted numbers, which you also have to take into consideration splits, and hit the changes, then this is what Abbott Labs looked like without considering the spinoff. And then, of course, in this regard, you could look at Abbott as part of your portfolio if you kept it, and also look at AbbVie as another part. But you have to do that on a pro rata basis, and these big companies actually do that for you. But I also want to make another point. I want to go back to Philip Morris here for a moment, because the idea is to make sure you're dealing with statistics correctly. When we report, like for example, we're reporting a blended PE of 10.6, okay, and we're showing earnings of, somewhere between $4.36 and $4.60, okay? If I get a quote on Yahoo, they're showing trailing 12-month earnings, that's what TTM stands for, of $2.44. So another question where people misunderstand statistics is they say, FastGraphs has to be wrong. You're showing $4 in earnings, and yet it's only $2.44 on Altria on Yahoo. If we go to Google Finance, you've got the PE ratio listed at 1968, and I don't know if they list earnings on here anywhere. But again, you've got a different data point. Now, here's the rub. If I go to FastGraphs, we're using adjusted operating earnings. We also have all these other earnings metrics. So if I went ahead and went to GAAP earnings, which are also called diluted, now you get that $2.40-ish number, which had to do with some big write-offs that happened, where you actually had a negative earnings of negative 70 cents in 2019. I think this was tax reparation. I'm not even sure what caused that, but the point is, diluted numbers don't always jive with things like adjusted numbers, and most companies, or many companies today, report them both ways. They also report basic earnings, which are going to be, in this case, very, very similar to what we saw with diluted, but we don't get estimate data. That's why the chart looks so different. So when you're dealing with statistics, you want to make sure you're dealing with statistics that you are aware of what it is that you're actually looking at. Are you looking at operating earnings? Are you looking at cash flows? Are you looking at GAAP earnings or diluted earnings? Are you looking at basic earnings, et cetera? And the thing is, we default initially to adjusted operating earnings, frankly, because this really tells you how the actual day-to-day operations of the business are faring. When you get into GAAP earnings, you start getting into accelerated depreciation schedules, charge-offs, one-time events, a lot of non-cash stuff. So this is more cash flow related, if you will, because that's what operating earnings are. It's kind of like, how is the business performing in the day-to-day activities of their business? So, when you're looking at these things, be aware of what it is you're looking at, and know that you're going to see adjustments made, when you look at these companies from different points of view. eBay would be another example where you look at it here with adjusted numbers before they spun off PayPal, and then you go and you do unadjusted numbers, which actually now will reflect the PayPal spinoff, and you see that here. This dropping line here is not really a price drop, it's a reset, if you will. Okay, and that's why we think it's relevant to draw them correctly. Now, again, Google adjusts the numbers just like we are on fast graphs. Yahoo typically doesn't adjust the numbers like you're seeing here. And on fast graphs, we give it to you both ways. So that's really the primary difference. So when you're dealing with, evaluating stocks and you're dealing with different data items, and by the way, I think it's important to deal with different data items. I think it's real critical to not just rely on, I get arguments all the time when the PE ratio is not valid. Well, yes, it is, but maybe it's not always perfectly valid. But then if you don't like PE ratios, look at things like operating cash flow. There's another good metric that can give you some good valuation and also give you some good insights into how the company's doing. That happens to be eBay there. If I go back to Philip Morris and look at Philip Morris, which I was showing you, you can see but yet you can see where cash flows, the price really didn't react to cash flows. Oftentimes that's the real problem when you're dealing with these, what I'll call gap type earnings, where you're not really looking at the day-to-day operations of the business. Here's AmerisourceBergen. You can see a huge spike in cash flows and the price reacted. If I look at it from a standpoint of adjusted operating earnings, I get a much, I think, more correlated reaction to price and earnings, but yet it doesn't explain this cash flow spike that I just showed you when I looked at cash flows. But then if I look at diluted earnings or GAAP earnings, you see these huge drops in GAAP earnings, but yet they had virtually no effect on the business because the business itself is continuing to perform. This is just how GAAP accounted for some of the transactions that the company is entered into. So always be aware of what metrics you're looking at. You want to be aware if you're looking at things like trailing 12 month or forward, and like, for example, if I go back to Altria, I do want you to notice they give you a forward dividend yield. Okay, they also give you a current dividend yield, but then they give you the trailing 12-month PE ratio and then the trailing 12-month earnings, but they don't really give you the forward earnings. But the point is, you want to make sure you're evaluating and understanding what statistical metrics you're utilizing to calculate these numbers. The numbers themselves don't mean as much. That's why I think the picture is so important. And, the idea that these earnings, these adjusted earnings, which, eliminate these non-cash charges, et cetera, it's just like EBIT and EBITDA, by the way. If you look at EBITDA, it's earnings before interest, taxes, depreciation, and amortization. And then if you look at the same company through EBIT, it's interest and taxes, so without depreciation. If a company doesn't have a lot of that, you're going to see different numbers. So be aware, make sure that you're always evaluating things with your eyes wide open. Statistics don't lie, but statisticians can be darn liars. And the data in itself can be very misleading if you don't see it in the context of past, present, and future. So I hope this gave you some further insights into how to analyze stocks. I hope it also gave you some insights into some of the power and features we're going to be adding with the new version of Fast Graphs when we get it launched. It's getting very close. For those of you who are subscribers and keep asking me, I really appreciate it. I also more appreciate your patience. This new version is going to be well worth it because we've also got a lot of other metrics that we're going to be. Initially, we're going to launch with a couple of additional metrics. Like, for example, we are adding a version of price per sales per share so that you can see if the company's trading at a reasonable relationship to its sales relative to, its historical valuations. And this is on a per share basis. You also have gross sales or gross revenues in the fund graphs, et cetera. But you can look at these companies in a lot of different ways, and I believe you should. And that's why we've tried to create a tool here that gives you the opportunity to do that. If you got anything out of this video, or if you enjoyed this video, please give me a like, ring the bell, subscribe to the channel if you haven't already. And I look forward to launching our new version of Fast Graphs for you in the very near future. And by the way, with the launch of the Fast Graphs, we're also going to be formally launching the Value U Academy, where we're going to be teaching you how to use statistics properly, how to read financial statements correctly, how to value stocks properly, and a whole lot more. Thanks for watching. Talk to you again real soon.